Hi everyone, and welcome to this evening's session, or at least it's evening for us here in the UK. But I know we have traders and investors from all over the place, and I suspect it's maybe afternoon or even morning where you are. But wherever you are in the world, you are very welcome to join us for this evening's session. And oh my goodness, so much has happened last week, certainly since we were together last Monday. But before we start, as always, may I draw your attention to, do you see the disclaimer on the screen? Oh, there we are. Yep, I just wanted to make sure that you could see it. If David can see it, then I know you can as well. You have seen it before. This is a very risky business. Please don't ever think of entering this market with money that you cannot afford to lose. And this is certainly, last week was delivered this lesson in spades, certainly if you were on the wrong side of the very strong market moves that we saw. Brilliant. I'm just going to take that down. And if you've not come along before, basically David and I, David is my husband who's sitting next to me, we run these sessions, and essentially what we do is we look at the concepts of volume price analysis and how that can be applied to the markets. And in this session, we very much focus on the US markets, in particular the indices. We look at some commodities, we're going to look at gold, and we look at stocks and the stock markets. And as I said, given what's happened last week, I think it's very, very appropriate. The concept of volume price analysis is not new. If you want to read more about it, then this is my page up on Amazon.com. I have a page for all the different jurisdictions, and they're really covered in the books that you see on the screen. So if you've never come across it before and you'd like more of an introduction, then those are the costs of the paperbacks. But I think it's $4.99. And the book I would suggest you start with A Complete Guide to Volume Price Analysis. And as you can see here, I'm very, very lucky. There are over 300, there are over, oh no goodness, almost 400 4.5-star reviews on this book. And I really have to tell you, sometimes David and I are very bad. We don't really make enough of a fuss, if you like, about the methodology, in the sense that we get so many emails from traders, professional traders, people who run funds, retail traders, independent traders, who really say that this methodology, this approach has truly revolutionized the way they look at the market. Because what it does, it looks at the market from the inside out. It basically looks at what are the insiders doing? What are the people who control this market? What are they doing? And once you start to think like them, your analysis of the chart will be revolutionized. So in this session, that's what we're going to look at. We're going to look at the volume price analysis concepts and how we can apply them to all sorts of charts, all sorts of time frames. And as I said, last week was a fantastic example of really, if you didn't have VPA, you really would be sort of floundering. So that's that. What I'd also like to say is it's all supported by our quantum trading indicators, and the ones we use in this particular session are for NinjaTrader. We're only going to be looking at the NinjaTrader platform, and that is it's actually what we call the Essentials package. Oh, here we are. There it is. I use Ninja 7. David uses Ninja 8. You won't necessarily see all the indicators on the charts this evening. You'll see some of them. David is, for example, he doesn't use standard indicators. I have moving averages on mine, but essentially, excuse the pun, they are from our quantum trading essentials package. And as you can see here, the cost of the package is $749, but you can buy the indicators individually, or the package, of the full package. And if you've got any questions about the indicators that we may be using, please just drop the questions in the chat box. I know also we have some of our quantum customers in the room as well. Lovely to have you join questions, or you've got any comments about what you've been trading and how you've been getting along, we'd love to hear from you. Right, that's what I want to say. I'm just going to pass you over to David, and then I've got a couple of points that I'd like to make, certainly following on from last week's webinar, what the markets have been doing, and then we will look at some charts that we've got ready for you. Pass over to you, dear.
Thanks, darling, and a very warm welcome to you wherever you are in the world. Good to have you here this evening with us, whatever time of day or night it may be where you are. Just very quickly, if you do have any questions at all, please just drop them in the chat box. If they're short questions, we're happy to answer them there. And for longer questions, we will try and answer them on air for you. So no problem at all. And Sam, thank you very much for your kind comment there about the complete volume guide, which you said is a treasure. So it's humbling. I have to say it is truly humbling reading some of the published comments on Amazon and also the myriad of emails that Anna gets from traders around the world in all sorts of markets. It's not just Forex, it's from investments, it's from trading stocks, it's from day trading, all sorts of different people. Who've said that, as Anna said, their trading and their investing has been revolutionized, and their understanding of why the market behaves in the way it does, and perhaps more importantly, the anticipation of what it's going to do next. That is the real key that the volume price methodology unlocks. It is the key to understanding what is likely to happen next. And it is just so powerful. And the beauty of it is, it's all from first principles. If you have a chart with price and volume on it, then you can apply it to whatever instrument, whatever market, whatever time frame you're trading. The same principles apply. It's like learning anything. If you learn something from first principles and you understand it, the world is your oyster, because you can apply it to whatever particular environment you wish to trade. I'm just going to pass back to Anna and we will get going.
Right, last week's sort of midweek meltdown that we had, certainly on Wednesday, and if you look at the extent of the moves in the indices, I mean, they were just you know, quite extraordinary. But cataclysmic was the word that we used, right? But essentially, really, all this sort of stemmed from well, the reason they say is, if you recall, sometimes as traders, we have the memories of, well, most traders have the memory of a goldfish. It goes around the goldfish bowl and has forgotten. But actually, it's not that long ago. But essentially, the Fed's interest rate path. And I actually wrote a blog post, as you can see here, back on, that was on the 6th, something like 6th of October, shortly after. And I actually said it was actually to do with the NFP, because we had the NFP and we had the Fed on the same in the same week, and I said, is it going to spook stock investors? Because, you know, the Fed's got this this interest rate rollout that they are proposing, and increasing interest rates are really not good for stocks, but simply because it's the cost of borrowing. And there wasn't very much reaction to that. There was very little reaction to the NFP and what have you. And it all went a bit quiet. Then, as I said at the beginning of the week, certainly when you joined us on Monday, we'd had some down days, but there's lots of buying coming in, supporting the price action. And we talked about it on the Monday as well. And then we had the Wednesday candle, which is this massive candle, as you see down here with this down bar, and you look at the volume underneath it, which, you know, is high, but given the extent of that candle, you think, well, hold on a minute, you know, what is actually going on? So,
sorry, darling, your cursor's in the wrong place again.
Sorry, David says my cursor's in the wrong place. Is it in the right place? Maybe I've got some delay on the internet here. Where is my cursor? Is it over there somewhere? Oh gosh. All right, well, I'm sure you know the candle that I'm referring to. It is, you know, you couldn't miss it. You can see it. I won't move my cursor around, and it's obviously clearly triggered a volatility candle as well. But if you look at the volume underneath it and the extent of that candle, that alone would tell you that, yeah, it was pretty scary, but come on, what is actually going on here? And then the next day, we had a further down day, but with a big wick to the bottom of the candle and a ton of volume coming in, which could only be buying. And that's when we wrote the blog post about a cataclysmic price action and volume. So Wednesday's meltdown, if you like, is the realization that higher interest rates are not good for stocks, as I said, the cost of borrowing, etc. You get this rotation into bonds, a sort of catch up with the Fed decision, but it also, against the background, you've still got the tariffs going on, the question about tariffs and what's going on with China, etc., etc. To that, we also have to add, of course, Donald's words as well, saying that the phrase, I think the word he used was loco, i.e. crazy to start raising interest rates. And it's actually a story that is going to become very prominent in the coming weeks and months, because the Fed, according to their program, if you like, their plan, is they have another important interest rate decision in December. So you can expect the rhetoric, certainly between the Trump administration and not the Fed directly. I don't think they will comment directly, but there'll be people commenting on their behalf. I mean, Janet Yellen has made comments as well. This is actually going to become very political. How it's going to play out, I don't know. Is the Fed going to, because in the Fed is it was created, those of you who don't know, it was created by an act of Congress in 1913. But it's not actually part of the government. It is and it isn't. It is actually I would say a private bank, but it is made. It has shareholders, and banks have shares in the individual Federal Reserve. So St. Louis, serious animal. It is independent of the politics, but that doesn't mean politicians don't have an influence on what they may or may not do. And I think it's coming to a point now, particularly with this administration, and I'm not criticizing the administration, I'm not passing a comment on the administration. All I'm saying is that the Fed raising interest rates at the rate that they plan to is not going to go down well with the current incumbent of the White House. Now, and the other number, and something else you have to be aware of, you'll be reading about what they call the interest rates at neutral. The figure you have to, that figure is 3%, where some way off 3%, but what they're saying is that, you know, things can go up to 3% and everything will stay the same, and, you know, what have you. So they're not even up to 3%. But what you can expect is a lot of rhetoric from the White House, and the ramifications certainly for really the US dollar, because the US dollar is the currency of first reserve. The US dollar has an enormous amount of power within the financial system, and with power comes responsibility as well. So as I said, it is a story that is going to run and run, and whether the administration, I don't know what they're going to do maybe about the Fed. Are they going to try and curtail it? Are they going to make it, are they going to politicize it in some way? I don't know, but this is a story that you're going to have to, us all, you know, take account of, not just the fundamental news, not just what the Fed may or may not be doing, but what is actually going on in background. And it's like Brexit. It's like you know, it's like all the other geopolitical events, influences that are going on at the moment. Right, that's all I wanted to say. We're going to have a look at some stocks, the volatility. We're going to look at FinViz. We're going to have a look at one particular metric with stocks, which is beta. If those of you who have not come across that before, just to explain a little bit about beta and how perhaps you can use it if you're certainly looking for stocks, perhaps to trade that aren't quite so volatile. Right, I'm just going to pass over to David. Do you want to take over the screen, David? Because mine's a bit, I don't know why my screen's a bit sticky. But as I said earlier, this is my Ninja 7. As you can see, it's lots and lots of the indicators on there, and I have the ubiquitous 200. I saw a lovely post today written by someone saying that it was trading over and above the 200 MA. I mean, it's almost iconic. There's nothing wrong with using moving averages as long as you incorporate them into, as I said, volume price analysis as well. Okay, I'm going to pass over.
Thanks, darling. And I thought we were just looking over around the shoulder just see if you've got my screen up. I just thought we'd start with the dear old VIX. I'm just going to slide that down to the bottom there so it's out of the way. I'm sure you're all familiar with the VIX, so I'm not going to explain what it is, but essentially it is the volatility index, and it works inversely to stocks. What's interesting about it is, this is one of the many cross relational aspects that you have to consider when you're looking at, you've looked at the VPA chart, you've looked at the daily chart, and you're trying to get a handle on that volume. And I'll move on to Ninja 8, exactly the same chart, you see it on Ninja Trader 8, in terms of the volume on the big down candle that Anna was highlighting. And what you're trying to get a feel for, answer the question is whether this is actually a cataclysmic event which has validity, or whether it's an event that has just been triggered for the single purpose of frightening the market to death, triggering a mountain of selling, and the insiders then moving in, the market makers then moving in to absorb all that selling pressure that's been triggered through this cataclysmic move in price action, and thereafter what the plan is moving forward. And one of those metrics is very much the VIX. Looking at the VIX, getting an idea on whether this looks correct, or is there an anomaly here? And when you look at the range of price action that the VIX moves in, what actually occurred, and this is the phase of price action here, the VIX only got up to the mid-20s, which, when you set that against the backdrop of a fairly massive move in the markets, it doesn't seem as though it is sufficient. And indeed, the price action is very similar, almost identical. We had this candle here, and I'll move over onto the chart in a moment. Then we had this big upthrust on the following day, and now we're starting to see the VIX slide lower. The region down here, about 12, we've been oscillating around there for a long time in this very long bullish run. And as I say, the move from there to 25 is not a big move for such a dramatic move in the market. And bear in mind that the VIX on occasion could get up to 50, 60 or 70 when it's really crashing through the floor. Then in the context of what went on the other day, it is increasingly looking like this is just a reactionary move. It was designed with one intent, and that is to trigger a waterfall of selling under fear. And of course, that was also reflected in other moves in things like gold, for example. And to send a message to Mr. Trump as well, indeed. That's what they do. You know, that's the power of the market makers. Like it or not, that is what they do. That's what they're there for. They're there to make money, not for you. They're there to make money for themselves. Okay, let's drop that out of the way. This is the chart. This is the daily chart. We're on the YM here. This is the futures contract. This is December contract for the YM, which is the futures contract for the Dow. So this is the equivalent of the Dow 30 we're looking at. But I've also got the NQ down here in these tabs, and I've also got the ES. The NQ is the NASDAQ. The ES is the S&P 500. They're not identical. They're fairly similar, but they're not identical. This was the move we were talking to. Hopefully my cursor is actually on the right candle. Looks as though it probably is. Just make sure it is. Yep, that's fine. This was the day. Look at the volume under it. Now, I'm not saying that's not high volume. It is. But when you look at the spread of the price action, we saw a move of almost 1,000 points. Does this volume align with this price action? I would suggest it doesn't. And what you would have expected to see under such a big move was much more what happened the following day, where we had this mother and father of a battle. A lot of buying and a lot of selling in here. Yes, you got a wick to the downside. Yes, you got a wick to the upside. Market tried to rally, heavy selling coming in. Market then fell, and then it was recovering. So there is a lot of buying in there. There was a lot of selling. The selling pressure was continuing from the previous day, but what was actually happening was that this ton of volume coming in here is actually buying. Now, that's not to say that this market is suddenly going to rally off this price action and is suddenly going to, as we say, create a V-shaped rally right the way back up to recover all the losses. The probability is, and that's what we suggested would happen, is that we will see consolidation at this region purely because there is so much. It's a little bit like an earthquake which has reverberations. It's a little bit like a tsunami where you get the after effects of the initial occurrence, and then you get the follow-up waves which follow thereafter, which are less severe but nevertheless do come along. So what you're expecting to see after such a dramatic move is further oscillations in the market, further of these days, long-legged doji candles, volatility. The market then calms and then reestablishes a trend, and that is what we're expecting to see. And in our humble opinion, we are expecting to see the market recover as indeed it has done previously. Only in our opinion, but that's based on our experience of what has gone on in the past, our understanding of how the markets work. It's based on the volume profiles that we're seeing at the moment, but expect more volatility. Now, the one thing I would say, we've got the volatility triggered on this particular candle, so we were expecting a consolidation phase to follow anyway, purely because that's often what happens. And in addition to that, the market makers cannot frighten the market to death, because if they did, it would kill the golden goose that laid the egg. Because if everyone was terrified of investing and buying longer term, then that would be the end of their money-making operation. So these moves are generally severe. They're pretty fast. It's triggered selling on fear. They move in, they mop up. This mopping up phase can take some time because there's still selling pressure coming into this market. We'll continue to do so, very much against the backdrop of the fundamentals and everything else, but that is likely to continue. It's very rare to see V-shaped rallies. We're expecting more consolidation. That's further confirmed by the fact that we've got the volume point of control is sitting here at just above 25,400, 25,440 area, this yellow dashed line. That signals the fact that this is the heaviest concentration of volume at this particular price level. It signals the fact that the market is starting to balance into a phase of price agreement, if you will. In other words, to use the market profile terminology, the fair value price, if you like, of this particular market right now is in this region. That's where it's all sitting. The volume profile is building. We've got the heaviest concentration of volume in that region right now. And what we're waiting for now is for the market to be confirmed, a move away from this region to be confirmed in due course and obviously confirmed with volume. And as I think we highlighted in the post, just looking at the volume profile as we move up the chart here, up towards the 25,800 region here on the histogram, then this is a pretty key area because this is a low volume region. So if the market does battle back and we get up to sort of 25,700, 25,750, then we would expect to see it move pretty rapidly through here on up to 29 and 25,900 and through to 26,000 rather, where we've got quite a heavy concentration of volume. And as the market approaches this region, then you would expect the market to run into some resistance at this level, because you've got both price resistance designated with the accumulation distribution indicator here. These are price levels of resistance and support, but you've also got resistance as a facet of the volume that's concentrated in that region. So once we get to that area, you're expecting the market to pause. If we get through there, we've got a low volume region here, so we would expect the market to slice through there fairly quickly, and on we go. And that's one of the key ways of using the volume point of control. It's a completely different aspect of the volume price relationship, because what you're bringing in there is time. It's the volume price time relationship, as opposed to this linear relationship here where we're looking at either a single candle and a single volume, or we're looking at groups of candles and groups of volume and phases of price action, whereas up here we're looking at the concentration of volume up and down the chart. So that's the YM. Now, in terms of today's price action, it's been what I would call a trader's day. And just popping that back up again, you look at this, you may not be able to see where the wicks are, but the wick goes to the top here, and we've got a wick that goes all the way down here. And just before I forget, one of the other key things about reversals, if we're looking for reversals, if we're a reversal trader, it doesn't matter whether we're trading on a daily chart or a 1 minute chart, makes no difference. When you get a long-legged doji candle or a big doji candle such as this, it's not indicative of a reversal in the trend. It's purely indicative of the fact that the market is in congestion. It does not indicate that the market is likely to reverse. It may, but it's not a signal that it will. It's just indicative of congestion. End of. So many traders look at this and they think, oh, it's a reversal coming along. It's not. It's just that you've seen this massive battle, this big tug of war here. We've had a big tug of war here. This is congestion. It's not necessarily indicative of a reversal. It's just a question of waiting and being patient. So that's the price action we've had today. This was the low, this was the high. So we've had another doji candle and we're trading around in here. We've seen it go higher, go lower, up and down all day long. Can you trade that as an intraday trader? You can. It's why I call it a trader's day, because I think it really highlights the power of using different charting techniques to help you on such a day. Because when you look at the daily candle, you think, well, can I make money in there as an intraday trader? Of course you can. Bear in mind that this range here, we're up at 25,420. We're all the way down to, where was the low? Down here, 25,220. So this is almost 200 index points. At $5 a point, that's $1,000 in that move. Just in that one move there's $1,000 to the upside. Probably about $500 or $600 in here. Another $600 or $700 up here. Maybe 500 in this move here. And that's trading one index future at $5 a point. So it just makes excuse the pun, makes the point that when you're using charting techniques to help you, even on days like this where it's a little more tricky, where you've got to be light on your feet, it's a blend of using what tools you have which are available. And the Renko chart is really powerful when used in conjunction with a time-based chart, with a volume associated, and you're using a blend of various techniques. We've seen it today. This is pop the Renko back up again. Just pull that out. I haven't got all the indicators on here. I've literally just got the support and resistance, which is the accumulation distribution, which is these dashed lines, the red lines and the blue lines. The thicker the line, the heavier the resistance or potential platform of support. I've got the trend dots on here, and I've got this set at 16. And what the Renko Optimizer indicator does on the NinjaTrader platform, it basically delivers the optimal setting. I've got this set to 1 minute at the moment, so I just select the 1 minute time horizon, and it's changed slightly. We've now moved, we click here and it says open an 18 brick Renko. So we've changed a little bit now, and that's something that, again, comes as a bit of a surprise when you say to traders, well, actually, the market speeds up and slows down during the trading session. It does. There is momentum in the market. So when you're trading the market, you want to try and be trading at the optimal setting. And what the Renko Optimizer does, it actually delivers the optimal brick size. Now, you can choose a brick size. If you're on the YM, you might like a 5 or an 8 or a 10 or whatever it may be. But this actually tells you at the moment that we're on 18. So every one of these bricks is worth 18 index points. In other words, $90. And that's what it does. It delivers that optimal setting for charting. And as you can see, the chart itself not only reveals momentum, but it also removes the noise level that can be confusing when you're on a price-based chart. So using it in combination with a time-based chart is a fantastic way to trade and use this particular charting device. We've got the trend dots on here. You can see they move very close to the price action. They also change very quickly. We're reverting to grey, we're into blue, we're in the uptrend. No change here. We had a down brick here, but then we carried on up. Then we see a grey one come in, a little bit of a pause point here. We hit some resistance building here. We carry on, we go back into blue. Then we start reversing, we get grey, then we're into red. and then we start the downtrend. The trend monitor, as you can see, is a little bit behind. The blue trend dot changed first. The trend monitor changes maybe a couple of bricks later, and that's how it's designed to be. It's designed to try and keep you in. The trend dot changes first, the trend monitor changes second, because it takes a slightly more considered view of what is going on in terms of changes in trend, whereas the trend dots themselves work very close to the price action and so will change much earlier. So it's very much a two-speed process. It's the two indicators we always recommend that you use in combination, because one is so close to the market and the other one is stepped back a little bit. You get the same effect here. We get to the bottom here, we're just changing. Now we're going back up again. And on we go, back into grey, back into blue. At the top, we get a little pivot formed. We get the three candle here. We get the three brick rather. We get a little pivot to the top. Tells us the market's reaching a bit of a resistance level. Grey dot changes, and on we go back down. And now we're firmly into the bearish side of the market. We had the transition through into dark red. Now we're into brighter red. We had a grey dot here in this transitional phase. We had a pivot low. We didn't go any higher than that. Back down again. Bit more congestion we're moving into. Now we've got some very strong, or relatively strong at any rate, support building at this region here on this dash line. Slightly deeper than this one below. This is less solid support, if you will. This is quite a decent support here, which is why we're seeing this tested. Of course, if it breaks through there, then that becomes resistance, and so on and so forth. And the trend monitor here is now bright red. We're seeing the dot here, grey, it's just flicking up there. I've also got the tick chart here. This a tick chart is another way of using a non-time-based chart, and what the tick chart takes its candle creation from, the mechanism it uses is the number of ticks. I've got this set at 987 tick at the moment. Again, I haven't got all the indicators on here. I've just got pretty much a bare chart. I've got the trend monitor, I've got the accumulation distribution, I've got the pivots on here. You can see the platform that's building here right now. But the important point about it is I've got this set to 987 tick. In other words, every time 987 ticks go through this particular chart, that is what causes the candle to close and move on to the next one. So if they are coming in very quickly, in other words, the market's moving really, really fast, then this chart will build very quickly indeed. If the market is very sluggish, getting to the end of the session, I mean, which is where we are now, so the momentum has kind of drained from the market. So we're seeing these candles form much more slowly. So if you actually imprinted how much time was involved in each of these candles, each one would be different, because it depends. It's not a metric of time, it's a metric of 987 ticks, how quickly those have gone through the market before the candle closes. And that information comes off this tick speedometer over here, which also gives us a host of other information. I won't dwell on it too long, but tick charts and Renko charts are great non-time-based charts to use in conjunction with your time-based and volume price analysis. And that was one of the reasons we developed the tick speedometer, not only to deliver the setting here for the instrument you're trading and again the optimal tick values to set that chart to, because if you think about it, again, it's guesswork. What do you set a tick chart to? Is it 100, 200, 500? What's it for the ES? What's it for the YM? What is it for this stock that I want to trade? You don't know. What the indicator does, it delivers that optimal setting here through the mechanism of the tick speedometer. But what this also does, it allows us to blend the volume price analysis, because we've got volume here and we've got price action, so we can consider that. And it also gives us a heads up when activity is high, medium or low. In other words, very high, we're seeing green. When the activity in the market is fairly sluggish, we get, or running an average, if you will, we see orange. And when the market is really in congestion and really has no direction, the volume's falling away, the tick activity is falling away, it moves into these red phases. So the green gives us an instant heads up as to, it's like a little alarm signal to say, hang on a minute, yeah, there's activity in the market, let's see what the price action is telling us, etc., etc. And then obviously you can apply volume price analysis in exactly the same way. So that's where we are at the moment. We are very much coming to the end of the session on, where are we? 10 minutes to go to the end of the US session for us in the UK. It's 10 to 9. So we're coming towards the end. And let's just go back to the Renko. Let's see where we're going with that. There we go. Let's just pull that over a little bit. We're still holding on the support platform here, which is providing quite a lot of support actually. But if it does break through there, then obviously that then becomes quite strong resistance to a reversal in the trend. Looks as though it's going to break to the downside. Yeah, I'm just going to pass back to Anna for a moment.
I've just passed over to, it's just to pass over back to my screen. I'm not going to move my cursor because it seems to have a mind of its own at the moment. So I'll have to check that out later. But this is the monthly chart, or sorry, it's the weekly chart of gold, which I think we've covered last week as well, didn't we? And there was a blog post that followed later on in the week, and it was actually really to do with, as a trader, you have a number of decisions to make as a trader. You've got to decide what time frame you're going to look at, and basically how long you're going to stay in a trade, and that will be determined partly by the time frame that you are looking to trade. But what you also have to look at is, it's often useful just to go and look at the slower time frames, because what they tell you is they give you an indication of the pattern, what's happening. Is it in a trend? Is it in a congestion phase? Because that will also dictate the type of tactics that maybe you're going to deploy in the faster time frames, and also what kind of trading day you're likely to have. And the gold chart on the week was just a fantastic example. If you look at the last big down candle that we have there, which was in October, September, which is towards the end of August, where we had that final big fall where gold got almost down to 1160, but it ended up with a wick to the bottom. So clearly there was buying coming in. Now, it didn't trigger a volatility candle, although it was a very wide candle, primarily because the gold had been more volatile in the past, so it was within its true range, as it were. It was almost a volatility, and what happened is the next candle, the green candle, sort of went into the spread of that candle, and it really, gold was just moving sideways. But look at the candle. So it was a trader's chart, in the sense that there was, some days where you had that up day, then you had some down days, then you had well, what could you say? It was a gravestone. It was, you can't even say that, a couple of doji candles, then you had a sort of hammer. And it basically, what it was telling you as a trader, that there would be plenty of trading opportunities on the faster chart. But as an investor, the chart was very clearly telling you what it was: time to be patient. You simply had to be patient. And in fact, your patience was rewarded last week, partly because of what was happening in stocks, and with the idea that higher interest rates are to follow, because gold has always been the traditional hedge for higher interest rates. When gold starts to go up strongly, that's what it's always been used for, as a hedge for higher interest rates, because it has a store of value. But it was just a fantastic chart, because it gave so many so many lessons, not just from a VPA perspective, but also telling you as a trader what was likely to be going on the faster charts, that you would give you your levels, should you how long perhaps even to hold a trade. If you look at those two candles that are kind of doji candles, that is good two-way price action, but you probably have to be pretty fast on your feet. You'd be in and out, which is great, because I think it was like a $20 range on that one, David, something like that. Yeah, very, very unusual chart. Now it looks as though it's going to be breaking out, although yes, last week you had that big candle there, the big wick to the bottom of the candle, is a decent amount of volume underneath it. We have to see how this week's candle ends up and what the volume is under that, whether in fact it's actually going to get up to 1240 is the next significant level for gold. I mean, the thing is with gold, every time it has a reasonable move, then you'll hear people coming out saying, oh, it's going to get to 1250, oh, 1260, oh, let's go back up. Where's the VPOC? The VPOC is actually 1300 is really the level that it's got to crawl back up to, and then obviously over and beyond. 1300 was where it actually came off, and you had that really nice downtrend all the way down, albeit with candles, as you can see, with attempts to rally, as it were, on the way down. But it finally does seem looks to be rallying, but boy oh boy, it's taken its time. Anything you want to add to that, David, or is that fine? I think just go back to David now and on his Ninja 8.
Amazing how the time goes when we're rattling away on these, and I hope you're finding them enjoyable. Back on the Renko, and this platform that we had has now been breached, and we're now moving. Where are we? Just coming to the close of the session, so there's always like to be a bit of volatility towards the end. But as I keep saying, each of these bricks is now. What are we on here? We're on 18. So each of these bricks is 18 index points. 18 index points is $90. So it's it may look inconsequential to pick up to 1 or 2 or 3 of these bricks, but I can assure you, there's decent money there. And all I'm talking about here is the smallest contract and one of. That's it. If you're trading multiples, then clearly, it's a lot more than that. Let's just shoot over to. I've pulled up 1 or 2, and just to go back to what I was saying earlier on about using the time-based charts in combination. Whatever you're doing, then you are going to be using multiple time frames, and multiple time frames will tell you so many things. You'll see volatility signals. You'll see bearish engulfing candles. You'll see bullish engulfing candles on different time frames. You've got different levels of support and resistance. You've got different indicators there. You've got different volume profiles, and it all tells you the complete picture. And what Anna was saying about gold, when you're getting a big move on an index, particularly where you're seeing a strong change in sentiment from risk on to risk off or vice versa, then clearly what you're going to be looking at in a dramatic move like that is very much gold, because you want to see that safe haven move. And you've got a whole raft of charts there to look at in terms of volume, in terms of price action, in terms of indicators and everything else. You would be looking at the yen, for example, what is going on across the yen complex. It always strikes me as odd that investors and day traders who are trading markets where sentiment is so key have no interest or understanding of the forex world. If they did, they'd probably make a better fist of it, because it is so. These markets are all interrelated. It's what we cover in the program. This is relational. No market operates in a vacuum. It just doesn't. So strong move developing. You can see there. If you're trading short this right now, you'd be picking up dollars by the handful now. And as you're coming to a close, you've got a decision to make. Am I going to carry on this? Am I going to roll over into Globex? Or am I going to close this out, take my profit, and head for the hills? That's a personal decision, but there we go. Let's just scroll. I've got a load of tabbed stocks here, and one of the things I did want to highlight, having mentioned volatility, is really just to highlight volatility from a stock perspective. Some of these I'm familiar with, some of them not. I just pulled them up off. In fact, let me just go back, pop that down. I'm sure some of you are familiar. We have referenced this site before, which is, where is it? Here we go, FinViz. It's a great free site if you're either a day trader or you're an investor. It's a fantastic free resource. Yes, it's littered with ads, but you can pay for it and you can get rid of the ads and set up your account and all the rest of it. But just as a quick way of stock screening, it's fantastic. You've got so many different options here. I've just screened out a load here on a change of 2%, and I selected large, I think, or can't remember now. I think it was the larger, here we go, large. You've got all these options here. You can go mega or you can go small, blue chip, whatever it is, and you just make your options, and it pulls up price moves on the day, which is one of the classical ways of doing it. You can sort on volume, you can sort on price patterns, pretty much anything you like. So it's a great resource. I just pulled that up to bring out one or two that were actually moving. Still got this strong move going on here. Just got my eye on that. And the ones I've pulled up here really just highlight the volatility. And in addition to that, also as a day trader, and we used to find this quite frustrating trading and investing in US stocks, because you get the quarterly earnings comes round, and we were writing covered calls, and it was actually quite restrictive because you had to cherry pick your way really sort of quite carefully through which stocks you were going to take options positions on, which were outside of the window of the quarterly earnings. And it's very restrictive because you are pretty much restricted to sort of two monthly sessions, if you will, before you into the next one, and then you've got to wait for that to subside, and then so you're constantly hunting around. It's a fact of life. If you're an investor, you've got to live with it. And I've got a couple here which I think have had earnings which have really spiked the market quite dramatically. But the point I wanted to make is this, that the volatility indicator, this little volatility indicator, it works on average true range. And what it does is it just highlights when price action has moved outside of the expected range for that particular stock on that particular time frame. It's very simple, really. But that's really what it's about. It's basically saying to you, look, hang on a minute, this price action is way, way outside where it should be. It's volatility. It's come into the market, and it's generally, not always, but generally associated with volume. So if you're seeing volume, you're seeing volatility, you can be assured of one thing: the market makers and insiders are actually operating in there. When you get these, the expectation is that the market will consolidate, because if it's associated with insider price action, then the purpose of these is to ramp the market up very quickly, to drag you into the market on an emotional response of the fear of missing out, FOMO, which is the most powerful. It is one of the most powerful. I was going to say it is the most powerful. It's certainly one of the most powerful emotive responses you will be put to when you're trading. When you see a market moving fast, I can assure you, your instant reaction is jump in. I don't want to miss out, and you jump in. And generally speaking, you'll be the market will reverse almost as soon as you're in. That's why it's done that way. So what the volatility is triggering, it's first of all signaling that, and secondly, it's telling you that the probability is that the market is likely to congest. It may well reverse, but at the least it will probably congest within and around that price spread action. And it's a question of being patient if you're not in. It's a question of being patient and then waiting. And the other thing with stocks, of course, which you get all the time, is you get gaps. You get gaps up, gap down, and that's something else we will have to deal with. Just pop that down there. Let's just have a look at this one. Hasn't got any volatility, but this is dear old Ford. This is just another facet of price action, which is congestion and a breakdown and a move away from a congestion phase. And this is just a classical move. I mean, Ford is now down at $8.80, trying to rally, but looking just so massively bearish, it's ridiculous. It won't go to zero, although I guess it could at some point. This is the volume point of control. This is a huge, huge area of support that was building all the time. And once that is breached, then if you're a breakaway trader, and this could be much higher level up the chart, it could be any time frame you choose. Once the market breaks away from that, then you've got a massive amount of protection, a barrier of price protection in place in the event of a reversal. You can see the market, we had this breakdown. You might have gone in here one of these days. The market reverses, but there is so much congestion above. It's going to be very, very hard for that market to break and change that reversal, change that longer term trend anyway, but change it on, if you're going to change it, you're going to have a ton of volume, and an awful lot more than this is coming in here to move that market and reverse the trend and break through all here. So when you're trading off congestion phases, and either to the short side or the long side, it's just a fabulous way of placing your stops in a very protected region above. In this case, if it fulfills your money management rules, the ideal place would be up here somewhere. You might even want to put it higher, but certainly up to this level For the market to break back through there is going to take a terrific amount of effort. It could be triggered by an earnings release, for example, but just in the general day-to-day movements in price, very unlikely that would be breached. So you've got a massive amount of natural protection. This is the market telling you where to put your stop loss. And it's just a classic example. I have a bias to the short side. So if I saw a chart like this at a higher level, I would have to contain my natural excitement and anticipation of getting into that market. I have to wait and wait and wait until that has been breached, the platform below has been broken, confirmed with probably rising volume on the move lower, and then you put your stop loss in above and off you go. You've got plenty of protection in place. Just very quickly rattle through this. This is Harris Corporation, ironically a company I used to work for many years ago in a different life. But this is just an example of what happens on an earnings release. This is an earnings release. We've gone from here, I think it's about $10 from top of my head. Yeah, we've jumped $10 in price pretty much, if not more. It's just a fact of life. You have to live with it. This is what happens. The earnings have come in better than forecast by the analysts, whatever they may or may not know. God only knows. But that's what they said, and the market responds accordingly. What you expect to see thereafter from this is, because we've got volatility triggered on the day, I would expect this market is going to congest, partly because you've got profit taking, partly because you've got volatility, insiders jacking the market up there, and they're going to sit there for a while. If the market carries on higher, if you're going to invest in that particular stock, then the best prospect is to wait for that market to move away from this region and then join the move higher. If you jump in now, the chances are this is going to go sideways, certainly probably a little bit lower in the short term before it actually rallies higher if it is a longer term trend breakaway for that particular stock. Just a couple more. A similar sort of picture here. Here we go. Another, lots of volume, volatility break, volatility triggered. Now we're back inside the spread of the candle. Everyone's pressured. People who jumped in here thought that wasn't a good move. Maybe they got stopped out on this move lower here. Gapped up again today. Tried to rally. We're trading around this region. This is actually quite a nice chart because at the volume point of control here, we've got lots of volume in this candle. If the market breaks through here and starts to move higher, then we've got this big platform of support in underneath, and it looks as though this could continue for some time. And also looking at the volume point of control, histogram up the chart, once we're through sort of 33.50 up to 34, we've got very light volume here, purely because they had this price waterfall on the way down. So on the way back up, like the elevator, this is going to move through here pretty quickly. Where's it going to stop? At the very least, it's going to pause up here because we've got massive resistance up here, huge lot of volume up here, and another layer above it at 37.80 odd. So it's all about looking at a chart, trying to find out where you think the market's going to. Another similar one here. Volatility, trading inside, moving up here. Why is the market pausing? Lots of different reasons. We've got the volatility candle. We've also got some pretty strong resistance here, and even stronger resistance overhead. This is a pretty cheap stock down there at $12.70 odd. Yep, and that was gold, which we looked at with Anna earlier on. I'm just going to pass back to Anna at that point. You can see this move down here. We've now moved since here. What have we gone down? Another 100 points. That's another $500 banked. Very nice. Thank you very much.
I've actually come back to the Finviz site because I said about beta earlier on, and David uses the 2% rule. So these are all the stocks that have had a 2% change. In other words, they've gone up. But you can actually, there we are, I can go up, right up to 20, and obviously down 2% as well. And clearly the stocks that have had a major change on the way up, and if you're looking, I don't know, if perhaps from an investment perspective, that's one way to screen, as it were. If you're looking to short, then perhaps look at a stock that is on the way down. For stocks that are, if you're an investor, clearly the vast majority of investors only ever look for stocks that are going to increase in value. The idea of shorting stocks is not really on their horizon. As a trader, you don't really care whether it's going up or down, you just want to make some money from the move. But the reason I've also added the beta, and I've actually put under 2. Now with beta, just to give you an example, something like Walmart is given at 0.26. That is considered a very boring, is not the word I would like to use, but it's a very steady stock. It is not going to be whizzing about all over the place, and you really, anything going up to 1 and below, above 1, 1.5, 2, and then they get higher and higher. They have a lot of volatility. If you're looking to trade volatility, then you would be looking for a stock with a high beta. But what I've done here, I've just used it really just as an example. I've combined the two, anything that's up on 2%, and but only those stocks that have a beta of 2 and below, as it were. But what it pulled up, which was quite interesting, is if you notice a lot of the gold stocks have come up. Certainly with Barrick Gold, you can see it's had a real push up over the last few days, and it's really not surprising given what how bearish the gold price has been. These are gold producers, and you will find that you know, they are going to follow the gold price to a certain extent. If gold is selling off, and you know, the cost of their commodities is going down, you've got the cost of extraction, it becomes more expensive. So, you know, following them and seeing you know, what they are up to. But they also provide, what I'm trying to say, also provide a trading opportunity if you are a stock trader, because obviously you'll be looking at the commodity, and the commodity is going down, and the prices and the stock's going down. Well, at some point it's going to reverse. It doesn't always happen for various reasons, but it's another way of being able to look at a related market to give you an insight of perhaps what is going on in maybe a futures contract, and as David said earlier, even on the forex side. But it's a fantastic, I think it's a fantastic site, FinViz, and what it's also very good at is once you use some of these filters, is then to go and look at the chart and look at the price action and the volume. And you can also see here the actual volume of shares that are actually traded. And we see here on Barrick is 23 million, so a lot of volume going into Barrick at the moment. So an interesting one to watch. Anything you want to add to that, darling?
I'll just wish through the questions. Have you answered them?
Let's have.
Very quickly, just to answer your question, Sam, on the chat box there. I'll do it on air because it's easier. Where does the money go when the money makers sell inventory? They're a business, so they are tasked with making a market. So they have to have cash. They buy and they sell all the time. That's what they do, and you know, they have to have cash to do that. They are there to make a market. So when you want to sell, they have to buy. And when someone wants to buy, they have to sell. That's how they operate. That's their function in life. It's what makes the market go round. Bloodhound, we do get asked from time to time about Bloodhound, but we're not planning on doing anything with Bloodhound. We have had a look at it in the past, but there's nothing in the pipeline for that at the moment, I'm afraid. HRS, there was the merger, but also it was on earnings as well. They came out with much better than expected earnings, and that probably in combination with the merger as well. But you know, M&A and earnings, you have to deal with it. The earnings are more predictable, obviously, because you know when they're coming out and the date they're going to coming out. Taking the other side, that they see both sides of the market. That's their advantage. They sit in the middle of the market and they see the books of both sides. It's a little bit, I'm trying to think of an analogy. Can't think of one on the top of my head, but basically they sit in the middle and they see the balance of buy orders and they see the balance of sell orders. And they know exactly what sort of inventory status is, and that's how they act in concert. It's as simple as that. And you know, they've been doing it for many, many tens of years, if not hundreds of years, and they do it very well. But the same principles apply in all the other markets as well. I'm going to pass back to Anna there to wrap up. I can see your chart. Yep.
Yeah, I've actually got the live volume coming in, and that everyone's saying, "Oh, market's slow, it's slow," but there's no volume underneath that bar. Unless that's going to change.
No, I mean there's just looking at Anna's chart there, just to wrap up. That's live volume coming in. That's pretty much where it will close off on the day. It's another candle of indecision. It's a nice trading day, as you've seen. It's an option to make money. If you're looking at this from the longer term perspective, then it's a question of being patient and waiting. There will inevitably be more volatility. It goes without saying. This congestion phase could go on for some period until the market settles and calms, and the trend is then duly re-established after this panic. It's what we saw, if you remember, back to February. I think it was late January, early February. I think we had a rally, then we had another phase, then the markets calmed, and the re-establishment of the longer term bullish trend. And that, in our humble opinion, is probably what is likely to happen on this occasion. And certainly the volumes are starting to suggest that it's declining, and the selling pressure is starting to be absorbed. There may be more moves to wash out the final remnants of selling pressure before that is all absorbed, and it's all part of the cycle of price action which we cover in the program, all to do with Wyckoffean cycles of accumulation and distribution.
And the level to watch is 25,400, which is about where the Reebok is, darling. Is that right?
Yep.
25,400. Brilliant. Thank you so much. Goodness, I can't believe we've gone on quite so long. Just very quickly to finish up, as I said at the beginning, it was the Ninja Trader platform this evening, with indicators from the Essentials package, which comes in at just under $800, but you can buy individual indicators, and if you buy one and you decide to upgrade to a bundle or the full package, we will always credit you with whatever you have paid. If you want more information, and I've got the wrong site up. Have you seen that? I've got Quantum Trading Education. I'm so sorry. It actually should say quantumtrading.com. I really do have to update my slides. But if you want any more information on any of the indicators, or indeed anything we've said, you could drop me an email, anna@annacooling.com, or you can email David at quantumtrading.com, or even helpdesk at quantumtrading.com. Helpdesk is where Jonathan mans the support team, and if you've got any questions about your indicators, if you are a quantum user. So thank you so much for coming along. We are back tomorrow morning for the London Forex session at 7:15, I think. I know some of you come along to that, but if you're not coming along to that, hopefully we will see you again next time, which I believe is next Monday. So goodness knows what's going to happen this week. But whatever happens, I'm sure it'll be lots of fun and happy trading. But do bear in mind what I said earlier, and keep an eye and keep a listen out to what Donald and the Donald and the Fed show. That should be that's going to be headline news in the coming days and weeks. So thank you again, and we'll catch you next time.